drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up, guys? This is Manoj Muktani. I welcome you all on behalf of the ADpedia world. It's been a fantastic day outside, and I'm sure that you guys must be enjoying your life, your surroundings, your environment to the fullest. Like as usual, guys. Perfect. So, we have been discussing a lot many topics relating to the chapter of capital busting, the most fascinating ones, the most exciting ones somehow. So by now we have already covered two of our video presentations which have been like solely dedicated towards the concepts which are relating to the chapter of capital busting. We haven't touched any of the practical question as of now, and in this particular presentation also I'll be covering a few more relevant topics in order to make you understand this chapter more clearly, so that while we'll be like solving a few of the questions, you guys don't get trapped with any of the topic which is just not covered. Absolutely. So let's mark the beginning of this wonderful presentation. But before doing that, I just hope that you guys must be honoring your word. That is making regular and recurring revisions, because that is something which is extremely crucial for all of you guys. Don't skip that up. Please don't try to escape from that kind of thing, which is absolutely necessary for all of you to consider. Perfect, guys. Fasten up your seatbelts. We're about to take off with the first topic of the day, and that will be replacement analysis. So, guys, as the name is suggesting itself, it's basically a kind of a concept wherein you'll have to understand the nuances as to when, particularly, you should try and go for a replacement. Okay, let's suppose I am having a machine, okay, and I'm running my business with the help of that particular machine. It's been quite a long period of time that I'm using that particular machine. Now, I've got two options, okay. Either I can replace that machine right away, right now itself, okay, and get the new machine for my company. Number two, I can get the repair and maintenance job done with the existing machine, okay, and I don't go or resort to the option of having a new machine at my premises. Currently, what I can do is I can just repair my existing machine and can use it for a period of, let's say, 1 year or 2 year or maybe 3 years down the line, more, without going for the unnecessary obligation of purchasing a new machine. Okay, so wherein you have to like think that you need to opt for a way wherein you can have this thing in your mind that whether I should go and purchase a new machine right away, right now, or I should go with the existing machine. Okay, I can get the repair and maintenance done and I can use it simply for a few more years to come. This particular decision that you make for your own company, your capital budgeting, basically, this particular thing is known as replacement analysis. Okay, so this is, guys, usually it's the most common kind of a situation, okay, in any kind of firm. And it usually happens with any company, be it your construction company, be it your hospitality, be it your uh, FMCG, any industry, okay, wherein they usually get into fix with this kind of a situation wherein either they should go for the replacement of this existing machine while comparing the same with the new machine, new purchase, okay. So if a firm is basically like trying to decide whether it should upgrade a new machine or its asset, or they should like go ahead with the buying of the new machine, this particular thing is known as replacement analysis. Okay, and usually what happens is, guys, whenever a financial manager which is being dealing with a replacement project, okay, they need to consider a few things. Okay, before you step into the shoes of being a financial manager for any of the company, you need to gouge out and you need to vouch out for some of the conditions, okay, before heading towards the replacement analysis. Okay, number one is the opportunity cost. Okay, replacement analysis should be done only if in case you have already considered the opportunity cost. Opportunity cost of what? Opportunity cost of basically the ones which is being generated by the old machine. Okay, let's suppose I can understand that you are willing to purchase a new machine. That's right, perfect. But think about the machine that is already available in your premises, okay, that existing machine, that old machine of yours. Is it really a condemned kind of a project, or it's a condemned kind of a machinery wherein that cannot be used at all? No, definitely not. There would be something out of which you'll be able to extract with that particular machine, okay, and you'll be able to extract something out of that machine. Technically, you will be having some certain kind of opportunity cost which will be relatively linked with that particular machine. Okay, so that shouldn't be ignored at all. That opportunity cost is extremely important, and it is a very normal practice to find the kind of depreciation, the remaining book value which is associated with an old machine. You'll be selling that machine off, definitely you'll be having some amount of money in your pocket. Also, you need to consider the depreciation which has already been considered with that particular machine. That is also a very important factor that you need to consider while buying another new machine. Okay, the value that would be like written off from that old machine, you need to consider that first. Okay, and then again there is the sale of old machine which is also involved herein. So the kind of money that you'll be getting while selling that old machine, whether the same is taxable or not, that will be depending on two of the things: whether the book value on which that particular asset is available in your books, and you'll have to consider the residual value, that salvage value. Okay, supposedly I have a I have a machinery at my premises. The book value remaining with that machine is, let's suppose, 10,000 rupees. Okay, however, when I go into the market, that machine can be like sold by my side for rupees 15,000. So what's gonna happen is I'm gonna make a profit of 5,000 over here, and on that particular 5,000 profit I need to pay the taxes. Okay, let's say 1,000 rupees. So my net inflow that I received while selling that particular machine was 4,000 rupees. Now that is one situation. Now let's think about the other situation wherein the book value, the residual value of that machine is, let's say, 10,000 rupees. And when once I go and enter into the market, I get to know that somehow I won't be able to sell that particular machine for, let's say, more than 5,000 rupees. 5,000 is the maximum price that I'll be like able to fetch once I'll be selling off that particular machine. So what's gonna happen is I will be basically taking up a loss of, let's say, this 5,000 now. Okay, so this is going to be the case in this particular case. So I need to consider all these things while I'm evaluating the decision of replacement. Number one, opportunity cost, then the book value, then the depreciation, then the salvage value versus the residual cost. All these, the amount of tax that I need to pay, all these things should be kept in your mind while you are like planning and you're like thinking to go ahead with your any of the replacement analysis decision. I hope you guys are pretty much clear that what you need to consider while you are going towards the replacement analysis. Now, coming back to the slide. Okay, factors that need to be considered while making a replacement decision. Number one, that I told you of, depreciation and the remaining book value which is associated with the old machine. Number two, the kind of tax benefit that you will be having if in case it's a loss making investment. Okay. Number two, uh, the tax liability that you need to incur if in case you have made out some of the gains from selling off of that particular old machine, that you need to consider up. Third, the kind of saving that you'll be having on your operating expenses. Now think of a situation wherein if I'll be purchasing a new machine and supposedly I'm using my old machine, okay, and I need to incur rupees 10,000 every year, okay, for the maintenance of that particular machine. Now I'll just bring in a new machine in replacement of that particular machine, that old machine. So how how likely is that chance wherein I'll have to spend each year 10,000 rupees again for the maintenance of the new machine? There are there are certainly the remote chances. Okay, if you're like already having a machine at your premises which is very old, in order to maintain that machine you need to incur 10,000 rupees every year. Are there likely chances that you need to incur 10,000 rupees for the new machine also? Absolutely not. The new machine is a new machine. So definitely it's going to cost you much lower if I'll talk something relating to the repair and maintenance part. So you'll be saving something onto your operating expenses, and that's for sure. So you need to consider that saving of operating expenses as well. Then there will be a change in depreciation. Let's suppose the earlier machine that you were working with, okay, that attracted a depreciation rate of, let's say, 10%. Okay, now you have just brought into some of the new machines, okay, and they are basically attracting a depreciation rate of, let's say, 15%. Now what's going to happen is you'll be able to book more depreciation each year as compared to the earlier one, okay, in the initial uh, years of purchasing that machine. So it's gonna cost you up much if I'll be like talking in consideration with the kind of factor that you need to consider while making any kind of replacement decision. Change in depreciation is a very important one. Lastly, the salvage value of the old machine. So let's suppose if you are planning to sell that particular machine this year, you'll be able to fetch, let's suppose, 50,000 rupees from the market. Okay. Now, if in case you are postponing your decision and if you are like willing to use your existing machine and not resort to buying the new machine, what's gonna happen is, if in case 3 years down the line, if you are willing to sell that particular old machine, you won't be able to fetch 50,000 rupees which you are getting now. Absolutely, you won't be able to get. Why? Because the machine is again gonna be depreciated a bit more period. Okay, so most likely you'll be like able to fetch from the market, let's say 25,000 rupees. So you need to take up this opportunity cost as well, wherein the amount which you will be like receiving today of 50,000 rupees is certainly higher than the one that you'll be receiving 3 years down the line. So salvage value of that old machine is also a very important factor. Now, lastly, equated annual approach will be used if in case you are evaluating the projects with unequal lives. What's going to happen is, let's suppose you have got three projects in a row. Okay. Now you're deciding which one to choose and which one to lift. Okay. So all these projects are like having unequal lives. One is for 3 years, another one is for 7 years, another one is for like 13 years. So, how are you going to compare each one of them? Simple. You'll be dividing the kind of present value that you'll be like receiving from all these three projects. You'll be dividing the same with their equated annual rate, okay, annual present value index factor, respectively. The present value index rate factor for 3 years will be like something else. If I'll talk about in comparison with the present value interest rate factor with respect to 7 years and 13 years down the line. So you'll need to divide uh, your NPV for all these projects from that annual equated approach method. Okay, and you'll get to know which project should be like opted for and which one needs to be skipped accordingly. So guys, this was all about replacement analysis. I was able to explain you each one of the thing over here. Now what's going to happen is, in my forthcoming videos, they're like got plenty of questions relating to replacement analysis over there. So all you need to do is just revise whatever I'm teaching you over here, so that while we'll be like discussing a few of the relevant questions which have like already been asked in CA final exams, you won't be like feeling that you didn't know anything at all. So that is something which is extremely important for you guys. That is the only reason why I'm explaining and making you understand each topic in such detail. Should I proceed further, guys? Let's move ahead with the next topic, and that will be the capital rationing. So guys, this topic is all about the scarcity of resources, okay, the paucity of resources. We all know this fact that we are having limited resources, okay, we are having limited amount of money. There is a likely possibility that you're having, let's say, 10,000 rupees in your hand, okay, and you've got two options, okay. You can take up this one project, or you can take up another project, okay. Now you need to allocate your resources accordingly, wherein you'll be spending or investing, I should say better, that amount of 10,000 rupees, and you'll be taking up one project, okay. Why? Because only one can be taken up. So capital rationing is entirely based on the same principle, okay. It basically refers to a situation wherein the company has to allocate, or I should say ration, the available capital in such a way that their shareholders wealth is actually maximized, okay. So that's the only thing which is need to be done as far as the capital rationing is involved. So like each year, what happens is, each company, like if I'll talk about construction companies, FMCGs, be it hospitality, be it marketing, any kind of company, be it, they usually, generally, these companies basically they set the budgets at the very initial phase of their year, okay, and subsequently what happens is, they basically attempt to select a combination of good projects, okay, with their main aim that they need to maximize their shareholders' profits, okay. They'll be using various techniques, let's say NPV technique, IRR technique, all these things, okay, and they basically tell us what good projects should be opted for, where they can accept keeping capital rationing in their mind, okay. So there is a likely possibility that not many companies and not many firms may be like having enough amount of resources. Absolutely, each and every company is facing some kind of crunches. So a firm may not have those enough resources to fund all these projects, okay, owing to their maybe internal or external constraints. This particular situation is basically known as capital rationing, and they need to ration their available capital in such a way that the shareholders' wealth is basically maximized. So any kind of company, okay, any firm which is having a good positive NPV, they usually face this kind of problem, because if I'm having like three of the options in my hand and each one of them is basically providing me the good NPV, okay, the positive NPVs, okay, so I need to decide which project should be like taken up for and which project should be like skipped about. So uh, and this problem arises why? Because I don't have one, capital in hand. Number two, I don't have I basically doesn't have that kind of a capacity to raise the capital which is needed to finance all these projects. Why? Because maybe my firm's reputation is not such good wherein I can uh, my credibility is not good in the market wherein I can borrow some of the money from the outside external environment as well. So my credibility is low. Number one, it could be a thing wherein my firm's stock price is just underpriced, or the market is maybe down, so nobody is willing to pay me those bucks. Accordingly, I can like fix up taking up all the projects. This is again a constraint. Number three, the cost of external financing is way too high. If I'll go into the market and I'll get some of the external borrowing, they are going to provide me the external borrowing at an interest rate of maybe like let's say 25%. So should I be like willing to spend 25% in order to take up a good project or not? So again, that is a constraint in my mind. Then there could be possibility that my external upper management may be like imposing some of the limits wherein they'll be like telling me that only this particular amount will be like available for you to invest. So again, I need to take up this factor into my mind while evaluating which project should be taken up and which one to be left upon. So all these things basically are gonna make you clear and clear with this fact that capital rationing is, guys, very much common kind of a thing in many of the projects. Okay, so you need to ration accordingly. So a firm which is having a good NPV project is said to have a capital rationing problem only if in case it doesn't have the capital in hand, or it doesn't have that capacity to raise the capital which is needed to finance those good projects. So uh, usually what happens is the firm may face a hard kind of capital rationing problem or maybe a soft one. So hard capital rationing is the one wherein the restraints which are being imposed are the ones which are being done from externally. Okay, the external markets will not lend to the company that kind of money even if they are having like positive NPV projects. So the external market is not going to help you out. So this is hard capital rationing. Then there comes the soft capital rationing, which basically occurs internally. There could be a possibility that the upper management of the company is not willing to go ahead with all the projects, okay, and they'll ask you that you need to end up taking up one project at a time. Then this particular thing is known as soft capital rationing. That's the difference between the two. I hope I was able to make you clear with the kind of concept relating to capital rationing. So, shall we proceed further, guys? Let's go ahead with the next topic, and that will be profitability index approach in capital rationing. So, guys, before thinking about something in relation to capital rationing, let's understand what does profitability index approach actually mean. Okay, let's suppose I have like invested, let's say, 10,000 rupees initially for a project. Okay, now all during the entire life of that project, I'll be able to, let's say, recover 20,000 rupees. Okay, from that initial investment of 10,000 rupees. Okay, the present value of all the inflows that I'll be receiving from the entire life cycle of that project is, let's say, 20,000 rupees. Okay, so now what's gonna happen is I'm gonna find out I'm gonna basically resort to an approach, okay, and which is known as profitability index approach. It's basically says that if I'll be like dividing this particular stuff wherein I'll be dividing 20,000 rupees from that 10,000, I'll get a number, okay, and the maximum number will be given a priority. Okay, the number which is highest in nature will be given a priority. Why? Because this is something which is very much relevant and very much obvious. If I like invested 10,000 rupees and if I'm like able to recover 20,000 out of it, then my profitability index will be 2, 20,000 divided by 10,000. Now supposedly the same situation, I invested 10,000 rupees, but out of the same, I was able to recover, let's say, 50,000 rupees. So, what's going to happen is I'll be dividing 50,000 from that 10,000 and I'll get a profitability index of 5. So, which one is a better one? If one situation is I'll be like investing 10,000 and I'll be like getting 20,000 out of the same. Another situation, 10,000 I'll be incurring and out of the same I'll be recovering 50,000. any day 50,000 is better as compared to 20,000. So the higher the number of profitability index, the better it is. And there are likely possible chances wherein you'll be like going for that project only, which is going to provide you the highest profitability index. This was all about profitability index approach. Now, coming back to what's the point of having the profitability index approach in capital rationing? Then what you should do? Okay, guys, capital rationing is all about allocating or rationing your available resources so that you can provide the maximum benefit to your shareholders. Perfect. So, how you can go about using the profitability index in capital rationing? Number one, first of all, you need to find out the kind of funds that are available with you for that capital investment that you are willing to make up. Okay, so first of all, you need to identify the funds which are available for the capital investment which are identified. Number two, now once you have already like found out or you have evaluated how many funds are you like having in your hands, next you need to consider the profitability index approach. Okay, wherein you'll be like dividing the present value of all the inflows of one project with the total investment that you are making, the initial investment that you're making for that project. Then you'll be getting the profitable index for all the projects. Absolutely, you will get. Then the projects are basically ranked in the order of PI. Let's suppose one project gave you a PI of 2, another one 5, another one 10. So lastly, what's gonna happen is the project which is gonna be chosen is only the one which is going to provide you the maximum profitability index number. So the projects are chosen starting from the highest profitability index and then moving down while tracking the cumulative initial investment and comparing it to the funds which are available for investment. So obviously in this particular case, you'll be going to choose 10 first of all, and then slowly and gradually you'll move on according to the kind of funds that you are having in your hand. And then when the cumulative initial investment, let's say 10,000 have been like spent for one project, another one 5,000, then another one 3,000. So what's going to happen is you'll be like cumulatively adding all those investments, 10,000 plus 5,000 plus 3,000. So by now, and when all your cumulative initial investment comes to an end, okay, it reaches to your capital funding constraint that now my money is just over. Then the investments are basically stopped and then no further projects are usually taken up. This is all about the PI approach in capital rationing. But do you think this is the only approach and it gives you the far more better results? Uh, well, I do have a doubt on this. Okay, so you're guessing it absolutely right, guys. There are a few of the limitations which are involved in this particular approach, that is the profitability index approach. So, what are its limitations? Let me tell you all these because I need to tell you in order to make you understand why you should go for this approach and why you shouldn't go at all. So, number one is that this particular project, this particular PI approach is basically forms the foundation only on the basis of capital rationing, wherein if in case you have got like let's say 10,000 rupees in your hand, there is one project which is basically providing you the best of the results. Okay, however, that particular project is uh, for rupees 20,000. It involves an initial investment of 20,000. All you have in hand is let's say 10,000. So you are still short of that 10,000. So what's going to happen in capital rationing basis is you may end up leaving that project at all completely. So you might resort for taking up of small amount of projects while you'll be like ignoring all the larger ones. Though they are going to provide you a huge amount of return as compared to the smaller ones, but just to fix up your capital rationing limit and just to complete it up, you may end up taking up some of the projects which won't be providing you that best of your returns as compared to the larger ones. So this is the number one limitation. Okay, so in order to fix up complete the limit of your capital funding, you may end up resorting to PI approach, which is just not the correct one. Then there are like n number of chances wherein you'll get to know that capital rationing constraint basically it applies to only current period. Okay, and it does not factor in investments which are required in future years. Is that possible that you're so much sure about one thing that you won't be having the capital rationing problem in future? Absolutely not. Any company can have this capital rationing problem in the future years to come as well. So PI approach basically ignores this thing because it is simply having a concept that I need to divide my present value of cash inflows with the initial investment. So it is clearly mentioned over here as initial investment and not the kind of investment that I need to make in the forthcoming years to come. So these are basically the kind of limitations that you'll be like facing if in case I'll talk about something relation to profitability index approach in capital rationing. This was all about PI approach in capital rationing, and I hope I was able to provide you the best of the examples in order to make you understand this concept clearly as well. Perfect, guys. Shall we proceed further with the next topic? Let's go. Cool. This is all about nominal and real rates of interest. So guys, what do I mean by nominal rate of interest and real rate of interest? Nominal rate, guys, is basically the one which reflects the kind of actual amount that return I'll be receiving over a period. For example, let's say I invested 1000 rupees, okay, at a 10% nominal rate. Okay, so what's gonna happen is at the end of the year, I'll be like having 100 rupees more in my hand. Absolutely, I invested 1000 and a nominal interest rate of, let's say, 10% was given to me. So at the end of year one, I'll be like having 100 rupees in my hand. So this is number one thing, which is good. Okay, but you also remember and you need to understand this thing that inflation is also involved in any of the economy. Okay, so the inflation, basically what happens with inflation, it's inflation decreases your purchasing power. Okay, so if you have 1000 rupees today and we assume that you will be able to purchase that 1000, let's say 1000 balls you'll be like able to purchase out of that 1000 rupees. So after a period of, like, let's say 1 year, okay, you'll be having 1100 in your hand, 1000 rupees plus 100 rupees as your interest. And on the other hand, you'll be having an inflation of 6%, let's say, okay, against 10% interest, you'll be having 6% inflation. So at the end of the year one, what was of rupees 1, that one ball of rupees 1 in the beginning of year one, at the end of year one, okay, that will cost you up as 1.06 rupees rather than 1. So now you have got 1100 in your hand after year one. Okay, 1000 plus 100 your interest, and at the same time you are having this ball price as 1.06 rather than 1. So what's going to be done by your end is you'll be dividing 1100 out from 1.06. So you'll get to know that once you were like able to basically purchase 100 basically 1000 balls out of rupees 1000 in the initial phase, if I'll be like having the same kind of calculation in my mind now, it should have been a case wherein if in case I'm having 1100 now in my hands, I should have got, or I should have purchased 1100 balls. But now, since the inflation rate is available in this particular case, so what's going to happen is I'll be dividing 1100 from 1.06, and I'll get to know that I will be like able to purchase only, let's say, 1030 balls. So what has happened, basically my purchasing price, my purchasing power has basically reduced by that 6.2%. Okay, so that interest of rupees 100 which I've got is worth only 38 rupees, or let's say 37 rupees. Okay, uh, that is the number of extra balls that I was able to purchase from that 100 rupees. So this is all about the nominal and the real interest rate. Okay, so now this was an example that I was telling you in order to make you understand this concept clearly. If in case I'll have to like directly hit the kind of concept, so 1 plus nominal rate will be equal to 1 plus real rate into 1 plus inflation rate. So the real value of money is only the one wherein I'll be dividing nominal value from the 1 plus interest rate. Okay, so that's how it goes on, and this was all about nominal rate of interest and real rate of interest. I hope you guys got the complete clarity with respect to this topic as well. Moving on to the last topic of this presentation, and this will be about the effects of inflation on capital budgeting. So what all effects are being left upon if I'll talk about something related to inflation on capital budgeting. So guys, number one, inflation will simply mean higher cost. Obviously, inflation means the costs are gonna go up now. So inflation will mean higher cost and higher selling prices. So the company that raises the prices might suffer a serious fall in demand, and which is gonna affect its cash flows. That is number one. Number two is the rise in price. Inflation would lead to an increase in the interest rates, thereby the cost of capital. So the amount which you were earlier like able to receive at, let's say, 10% interest cost. Now for the same, you'll need to pay, let's say, 15%. So what's going to happen is your demand is going to be decreasing in this particular case, and you'll try to fix up something else rather than going and resorting for the loan amount. Number three, your fixed assets and the stocks will increase in money value. The same quantity of all these assets must be financed by increasing the amount of capital. Let's suppose uh, inflation is going on. Okay, so the asset that you purchased earlier at the initial beginning of the year, let's say it was costing you up 10,000 rupees. Now inflation is like hitting to the country. Okay, it hits back somehow, and the same machinery is now being sold for, let's say, 12,000 rupees rather than going for 10,000. So what's going to happen is it is going to increase your money value. Okay, and for the same amount of quantity in that one machine, now you'll have to like spend some more bucks. Okay, so that needs to be like funded with the increasing amount of capital in any of the cases. This was number three. Number four, again, if the cost of all the raw materials or inventory basically they increase, so what's going to happen is it will also increase the requirement of the net working capital. Okay, now you'll be requiring more of the net working capital as compared to the one which you were earlier requiring. Okay, as a result of increase in that overall proportion of the overall finance which is required. This is something which is uh, very much important if I'll talk about something in relation to the inflation on capital budgeting. That was the number four point. And finally, if I'll talk about the lastly, so inflation will cause the firm to reduce its capital budget. I was able to, let's say, buy 10 quantities from for let's say 10,000 rupees. Now, since inflation has hit back, okay, and for the same reasons, I will be like able to procure or purchase only 8 items out of that 10,000 rupees. So, what's basically the thing which has happened over here? That inflation will cause the firm to reduce its capital budget somehow, and this is going to be attempting to reduce the net working capital or to alter their debt asset ratio using that short term debt, and which is going to drive up to all those short term rates which are relatively in comparison to all the long term ones. So inflation causes the firms to reduce their capital budgets as well, because they don't allow the company to go ahead in that particular case. So these were the effects that inflation will be having on capital budgeting. So you'll get to know more about this while we'll be like solving a few more questions in order to make you understand this concept properly over there as well. So I hope I was able to make you clear with all the kind of concepts in this particular presentation. All you need to do is just remember that you need to revise and retain all the topics that I'm covering with you guys. Whatever things I'm doing for you guys, that each effort of mine will go in vain. Each effort will be in futile if in case you don't revise your topic. That is something which is extremely important, guys. So go ahead with the same. With this, I'll say thank you on behalf of the Edupedia world. Keep interacting with our questions, queries, in YouTube comment boxes. I would love to answer each one of your queries and grievances. If in case you have got this video found to be like informative, and if in case you have liked our video, do give us a thumbs up, do give us some positive comments, so that it will help us in increasing our morale booster as well. Stay connected. That will help us in understanding your needs way, way, way better, guys. I'll see you in the next presentation with some lot more exciting topics. Till then, sayonara. God bless you all. Take care. Bye.